Okay, hi everyone. This is going to be the first lecture for chapter 16. Get that out of the road there. So we're looking at corporations here, right? And corporations, they file the 1120. And this form, right, here's kind of a simplified version of it, an even simpler form here. It's going to be similar to, at a very basic level, a 1040 in the sense that, hey, you're going to have your income, your deductions, your tax liability, right? Back out any credits and prepayments. You're either going to owe money or you're going to get a refund. And this is like a super simplified version in the sense that most corporate tax returns are very complex, right? And we will see as we kind of build out this lecture why, the different areas, the reasons for that. On one side of the coin, right, when I was in practice, I saw C Corp returns that could take, a few hours, half a day, like a really small baby level C Corporation. On the other side of the coin, right, when I was at Big Four at Deloitte, hey, there's entire teams, 100-person team that deals with, a C Corp return. There's just one aspect of that, maybe the provision, right? You have like a provision team. So in any event, right, it's kind of a similar setup. There is no standard deduction versus itemized deduction in that framework. And when we talk about a corporation, there's certain things to be aware of, right? So there's limited liability. If you're a shareholder, the most you can lose is up to your stock value. The corporation has an independent life. It's its own entity, right? It can enter into contracts. It can sue or be sued. There's ease of transfer of ownership. Hey, I don't like my stock. I'm just going to sell it. Somebody else can buy it. There's not a lot of headache there, like approvals we have to get. You are talking about double taxation, right? So say that we make $1,000 for the corporation, right? That's going to be taxed twice by the time it reaches the shareholders. In other words, once at the corporate level, they're going to pay a 21% rate, right? So let's just keep it simple. Say, hey, they pay $200, right? And then there's $800 left over, right? We made 1,000, we paid 200 in tax at the corp level, $800 left over. If and when we push that $800 out to the shareholders as a dividend, they have to then pay tax on that. So that $1,000 that we earned, by the time it reaches the shareholders, it's now been taxed twice. So here's the form of the 1120. Again, don't be deceived, right? I mean, it's a tax form, so it does look overwhelming there, but these are kind of the important parts of it. On the front part here, page 1, you're going to be looking at things like your income, your expenses, things like that. Schedule L, Schedule M1, M2, these guys are really important in practice, right? So you always want your balance sheet to balance over here, and this is your book balance sheet. You want your M1 to show, hey, how did I get from book income to taxable income? And then your M2 is going to look at your retained earnings. So we'll kind of talk about this throughout the lecture here. But when we're talking about C Corps, right, generally their tax year end is going to be their financial accounting year end, right? So, hey, for book purposes, I have a 12/31 year end. For tax purposes, I'm going to have a 12/31 year end. And in fact, that's how most corporations, how it works. They're going to have a 12/31 tax year end, and then the corp C-tax return, the 1120, is due 4/15. Okay. And on this return, right, in the beginning, they got to elect their overall method. In other words, for tax purposes, are we going to be an accrual basis taxpayer? Are we going to be a cash basis taxpayer? Or some type of hybrid in between? As a general rule, right, you're allowed to pick either, right? You can be cash, you can be accrual. However, if you are a large taxpayer, in other words, if we look at your average annual gross receipts for the last 3 years, if they exceed $29 million, and it's stated in the negative in the PowerPoint here, but the general rule is, hey, you're greater than your average annual gross receipts for the last 3 years exceed 29 million, you must use the accrual basis. In other words, cash method is off the table. And anytime you're dealing with taxpayers, right, they're probably going to prefer cash method in the sense it's easier to do for tax. It's a little bit more flexible with like shifting when you recognize the income and expenses, whereas accrual is much more like fixed, rigid. It's definitely more accurate, right? If you remember like your financial accounting days, it's more accurate to present your income that way. But the idea with this is they didn't want to burden taxpayers with having to do, accrual basis tax returns. So they really only left that to large corporations who have the resources, the staff, the money, right, to handle the kind of the bigger complexities that come along with being a large taxpayer. All right, so the name of the game for this chapter and kind of a lot of the questions on the exam are going to be, hey, here's some book income. Please tell me the taxable income, right? There's at least a handful of questions on that. And essentially, why do we do that, right? What's the setup here? Well, we have two different taxing authorities. In other words, we have the FASB that makes GAAP, right? One set of rules. And then we have the IRS that makes the IRS code, right? The tax law. So we kind of have like two different people here, right? So in order to report our tax income on that 1120, right, we're going to have to look at our book income and adjust it, right? We're going from book to tax. And in this way, we can either add stuff to book income or we can subtract stuff from book income, right? Anything that you add to book income is going to be unfavorable. And it's unfavorable because you now have bigger taxable income, right? If you have $100 on your books and you add $20 to it, you now have $120 on your tax return, right? Anything that increases your taxable income increases the taxes that you have to pay. Accordingly, add backs are going to be unfavorable. In distinction, anything you subtract from book income, right, is going to be favorable. Smiley face, right? That's a good thing. Hey, we have $100 on our books, but we're only reporting 70 on our tax return, right? We pay less taxes, right? That's great. That's a smiley face. So that's one way you can categorize these adjustments, right? They can be favorable. That is to say, they can decrease taxable income, smiley face, or they can be unfavorable, that is to say, increase taxable income, frowny face. All right, so you can look at this, right? Here's just kind of a simplified version of going from book to taxable income. Another way we can categorize this going from book to taxable income, the adjustments, is whether they're permanent or if they're temporary. And this is really a if versus when question. If you get a deduction on books that you don't get on tax return. When you get a deduction on both. So let me talk about permanent differences first, right? So this is if you get the deduction, if you report the income. In other words, a permanent difference is where it's just permanently going to be different between the two rulemaking authorities. By way of example, right, muni bond income. GAAP says you got to include it, right? It's income there. Tax return says it's excluded. You don't report it. That's permanently going to be different, right? That's never going to change over time, right? We're calling it a day. It's permanently different, all right? So that's an idea of a permanent difference. And again, it can be income, it can be deductions, but I'm just giving you a simple example. In distinction, you have temporary differences. So instead of this being if you get the deduction, if you report the income, it's when you report the deduction, when you report the income. So by way of example, right, depreciation, right? Say we buy $1,000 asset, right? That's great. For taxes, if you remember 179, the blue show where you immediately expense it, we're taking that expense all in year one, $1,000. In distinction, right, on the books, we're doing straight line, right? We're like the little engine that could, $100 a year, $100 a year, $100 a year. Accordingly, right, we're going to have a book to tax difference. We're taking a big deduction in year one, but we're kind of doing $100, $100 on the books throughout years 1 through 10, right? So initially, we're going to have a favorable temporary difference, but it will reverse over time and become unfavorable, right? In years 2 through 10, it will be unfavorable insofar that we get a deduction on book, $100, but we don't get it on the tax return. We already took it. So the idea with these is they reverse over time. And this is kind of, what I have here. It's kind of like, imagine, you're playing the water gun game at the amusement park, right? For depreciation, right? The idea is that little alien, that thing like shoots up real quick in year 1, right? It's all the way to the top. They win. Then you got the other alien that's just kind of slowly going up, right? $100 a year, $100 a year on your books. Eventually, right? They will all go to the top. You're gonna get the $1,000 for it, the expense. It's not if you get it, but it's when you get it, right? So that's the idea with it. So here's some, important permanent book to tax differences, right? So we got the permanent marker there. We just looked at muni bond income, right? That's a big one, right? You can look at these other ones. What are some examples here, right? So meals, right? What's the idea with this? On book, you get 100% deduction, but on tax return, you only get 50%, right? So that's unfavorable. We don't get as big of a deduction on the tax return. Entertainment expense, right? On the book, you get the entire thing, but you get nothing on your tax return, right? That's not a good thing. Same idea with kind of fines, fees, penalties, political contributions. You get a deduction on book, but never on the tax return, right? So like I said, I could say to you something like, hey, here's your book income. Please be aware they got a muni bond, they got meals expense, they do this, they do that. Please tell me, and you're going to have to adjust to arrive at taxable income. So if we look at, right, example 1 here, hey, we got 100 grand of book income. We make our adjustments, right? The muni income, well, hey, that's not taxable. Well, if it was part of book income, but it's not part of taxable income, we got to back it out, right? The life insurance premium for the key employee, the idea with that is that's a book deduction that you don't get on the tax return. So we deducted it here, but we're not allowed to deduct it in tax land. We got to add it back, right? Likewise, M&E, you only get half of it. Well, we deducted 100% on the books, but we only get 50% on the tax return. So we got to add back 50% of that. It's almost like you undo the cheat codes, right? You reverse out the stuff that happened on the book return. You adjust it to arrive at taxable income. All right, then we got some temporary differences, right? So this is really when you get it, whereas this is if, right? So here you're going to get it. The alien thing's going to reach the top. It's just, when do you get it? And the big one here is really depreciation expense, right? That's the most common one you're going to see. That's a temporary book to tax difference. And a lot of times, because we have this really like accelerated upfront tax depreciation, it's a big expense up there for tax upfront that is more slow over book. Other things here, right? You can look at these bad debt expense, right? So what do we do on the books? Well, hey, at the end of the period, we basically make an estimate. We use the allowance method, if you remember from the financial accounting days, right, where you got to like put it into the buckets and what's the percentage uncollectible, right? And we just say, oh, we estimate this many accounts we're not going to collect. And essentially for books, you would take the expense in the period of sale, right? In distinction, right, we don't do that on the tax return. On the tax return, we do the direct write-off method. And essentially what that says is, we don't make an estimate. Instead, we wait until next period, right? Whenever, right? A year after the sale, 2 years after the sale, unless and until the customer comes and unequivocally conveys to us that they're not going to pay us, then and only then do we take the expense for bad debt expense. It's only a bad debt. We're not going to collect on the debt until the guy really tells us he's not going to pay us. Then we take the expense. All right, so you can look at these here. Warranty expense, kind of similar thing there. Read through them. I'm more concerned with kind of the main ones we discussed there, but so look at them. All right, next thing here, right? So we're looking at some kind of more nuanced or complicated book to tax differences. So let's start with dividends, right? And the best thing you can kind of do to keep this straight in your head, and the class notes kind of outline this, right, is what you do on the tax return, right, versus what you do on books. Right, so I don't know, let's just say we had an entity, right? Let me use one of these markers here, right? Let's just say they pay $1,000 dividend. They have 100,000 in income, and we're, I don't know, a 25% owner. All right, so first off, we're talking about dividends, right? In tax world, whenever you receive a dividend, it's going to be fully taxable. All right, we got $1,000 of income here for the corporation. On books, right, so if you remember your financial accounting days, it really comes down to what percentage do you own of this corporation? Do you own 0 to 20, right? What's the other percentages here? 20 to 50, or do you own 50% plus? Right, the idea with this is, right, if you owe 0 to 20, then you're going to basically include the entire dividend, right? $1,000. Hey, that's great. There's going to be no book to tax difference. If, however, you use the equity method, right, you basically ignore the dividend and you say, oh, okay, my income is going to be the percentage of this, right? So, right, my income kind of ebbs and flows. I track it with the business. How the business does is my income. Well, in this case, right, I'm going to have $25,000 of income, right? So there will be a $24,000 book to tax difference. And it's actually a favorable book to tax difference, right? Because we are reporting less income than what we have on our books. Finally here, right, if you own more than 50%, right, you would consolidate your books and records, right? It's like intermediate accounting too, advanced stuff. Don't worry about that one for the exam, the 50% there. But that's the idea, right? We're talking about dividends. Generally, they're going to be the same. Once the equity method gets involved, they can be a little bit different. All right, next thing here is goodwill. Okay, so how do we do this for books, and then how do we do it for tax? Well, generally for books, right, you're going to basically say, okay, one business is acquiring another, right? So maybe you have, Amazon that's acquiring Whole Foods. That's great, whatever, that's fine. The question then becomes like, well, what basis does Amazon have in Whole Foods assets, or what basis, if it acquires the stock of Whole Foods, does it have in that, right? So if you think about it, there's like two ways if you want to control business. If you wanted to own Whole Foods, you could, one, buy all of its stock, right? 100%, I control it. Or two, alternatively, I'm going to buy all of your assets, right? So if we're looking at it, right, essentially for book, right, if you acquire the stock or you acquire the assets, most of the time what you're going to do is, right, you're going to compare what you paid, right? I don't know, maybe you paid 100,000 for Whole Foods, or 100 million, whatever the number is. You got $70,000, right, the fair market value of the items there. And then, hey, I guess 30 million must have been goodwill, right? Essentially, what I then do is I test that, periodically for impairment. right? So the expense for Goodwill on book is really the impairment expense. Now, the question then becomes, well, what do you do on the tax return? So on the book, maybe I'll have an expense if there's impairment. Well, for tax, it depends if you acquire the stock or you acquire the assets. Generally, for acquiring the stock, you're going to take a carryover basis for most of the assets. A lot of the intangibles, right, like things like that, are going to be a $0 basis or close to $0. And in that way, right, what would be the difference between it? Well, hey, you could potentially have a goodwill impairment, but that wouldn't really happen in tax world, right? That would be a book to tax difference. Likewise, on the tax return, if you acquire the assets, right, of the target, then to the extent you have that excess purchase price, the $30,000, you're going to amortize over 180 months. So this will create a book to tax difference. In other words, what's going on here? We have one business acquiring another. It's acquiring the assets. For book, the goodwill will be tested for impairment. For tax, the goodwill will be amortized over 180 months. So let's look here at 16.5. All right, so we have a corporation that acquires the assets of another business on 7/1, halfway through the year, right? So that means it's going to be a short tax year for 6 months, right? So we only get the first year we have this, it's only for 6 months. It's a short tax year. It looks like, hey, for both of them, our books and our tax, we have 180 grand of goodwill. That's great, but remember, we do different things here. On our tax return, we amortize it. On our books, we tested for impairment. In this case, it looks like there wasn't any impairment. Now, in other words, what we did is we took an expense on our books for 6 grand under the amortization, even Steven, 180 months. Nothing happened on our books. Accordingly, there's going to be a $6,000 favorable book to tax difference, an expense we got on the tax return that we don't get on the books, right? And then over here, it just shows you the reverse setup, right, where there is more expense on the books, like a big impairment, versus when we were doing that kind of even Steven 180 months for the tax return. Okay, the next couple items here are stock options, right? So the idea with this is whenever you are an employee, right? So here's the business, right? We'll just call it a corporation. And here's an employee, right? Obviously, they can pay you in money, right? Right? Oh, you're a starting accountant, you're going to make 50 grand. You're going to make 60 grand, right? Another way they can compensate you are through stock options, right? Normally, where you will see stock options are kind of two setups. In other words, a lot of times, like the big wigs, right, in publicly traded companies, like you're a board member, right, like Steve Jobs or something, a lot of their compensation's in stock options, right? So that's one place you'll see it. Another kind of realistic place you'll see it is if you're serving startup companies, right? A lot of like startup companies, so I have friends who like work for them who are like computer programmers. Maybe they get like 100 grand in salary, but they're going to get like 150 grand in stock options, right? So the question for this becomes, we talk about a stock option. For the corporation, just like it gets a deduction for paying you cash, a compensation expense, it's also going to get a deduction if it gets you a stock option. In other words, it's a form of compensation, right? But what specifically is a stock option, right? It gives the holder, right? So you're working there, right? The right, but not the obligation. You don't have to, but you can purchase the stock in the future at a price set today, right? So here's an example, right? Let's say the stock right now today is trading at 10 bucks. The corporation, right, your boss comes up to you and says, hey, you're a great employee. We like you. We want you to stick around. We're going to give you 100 stock options, the terms and conditions of which says, hey, in 1 year from now, you can buy 100 shares for $10, right? So it gives you, the holder, the right, but not the obligation to purchase the stock in the future 1 year from now at a price set today, $10. So here's the deal, right? You're like, okay, this is great. What you're going to do is kind of like the little worker bee and the little engine that could, right? You're going to work hard, right? Because if you work hard and you do good at your job, the value of that company is going to go up. Okay, so they kind of put the carrot in front of your face with these stock options. Accordingly, right, let's say it's 1 year from now and you did a good job, or the company's doing great and the stock is selling for $12. What you do is you say, okay, I'm going to buy it for 10, right? And then I can sell it for 12, right? I just made $2, right? I bought it for 10, I sold it for 12. I get 100 shares I can do that for. I just made $200, right? So that's kind of the idea with a stock option. And in this framework, you have to be aware of some of the kind of the dates with it, right? So there's a grant date, a sale date. A grant date's when they kind of say, hey, here you go, I'm giving you this to you, right? Here's the option. The sale date is where you actually sell it, right? That's where you make, in the example, like $2 per share. The exercise date, right? This is when you basically buy it, right? You're going to buy it for 10. In the vesting date is when this kind of gets locked in, right? In other words, it says, hey, here's the deal you got, right? $10 in a year from now. You have to hang around. You have to be here until the vesting date in order for this to lock in and qualify for this. Stated alternatively, if you leave before this vests, you don't get anything, right? So this is kind of the carrot in front of your face. Why companies will pay you for this in this manner is because it keeps you around, right? I'm stuck there, right? I have friends, like I said, who work for startup companies. They're like, I can't leave because I got to stay until my stock options vest. All right, so that's the idea with it. How do we treat it, right? So let's start with book first, right? Book, right? We said it's a type of compensation expense, right? It's just like debit wage expense, right? Debit wage expense. But the question becomes, when do you do this and for how much, right? So essentially under book, what they say is you're going to estimate on the grant date the fair value of the options, right? So the idea with this is, hey, here's the grant date. We're going to give you, some stock option. Again, this is from the corporation's point of view. We estimate the fair value of this is $200,000. Okay. And let's say that the vesting period is 2 years, right? Year 1, year 2, then it locks in. Essentially, right, for book in year 1, right, we're going to take 100 grand. And in year 2, we're going to take 100 grand. In other words, we recognize the deduction, accrual accounting, as it occurs over ratably the vesting period. In distinction, right, for tax, what do we do here, right? Because it's going to be an expense on the tax return, right? Well, in tax, we first off have to say, right, what type of stock option is this? Is this an ISO or is this a non-qualified stock option? So these are terms like embedded into the code. If it's an ISO, an incentive stock option, right, you are never going to get a tax expense, right? So this is unfavorable permanent, right? You don't get anything, right? ISO is missing over here, right? You don't get anything on it. It's never you get the deduction. If, however, it's a non-qualified stock option, essentially what the corporation deducts is the bargain element in the year in which the employee exercises the stock option. So in other words, here we get the deduction when they exercise it based on how many shares they exercise with that sort of built-in gain, the $2. So let's look at an example here. So this is just saying, hey, on our books, we did, a stock option over that vesting period. It was $15,000 we took in year 1. It was an ISO. You never get that on the tax return. Accordingly, there's a $15,000 unfavorable book to tax difference. All right, next one here. Right, this is a non-qualified option. And the idea for this, you can look at it, it's essentially 3 years, right? Year 1, year 2, year 3. Because it's a non-qualified option, we estimate the value up front for book, and we do it ratably, right? So in this case, if you read the facts, right, they're going to get 100 and 100, right? They estimated it's 200 and it's over 2 years, right? So in year 1, they get 100,000, and on year 2, they get 100,000. But guess what? During those years, the person, the owner of these stock options didn't exercise them. And we know on the tax return, you only get the deduction when you exercise them. So while we got 100,000 there, right, we get 0 for tax. Accordingly, it's unfavorable, right? That's a frowny face. We got a deduction on book we didn't get on tax. In year 3, however, right, then what happens is, hey, the employee exercises them, 20,000, right? It looks like he's going to make 15 bucks on each share. In this case, right, in year 3, we're going to have $300 on our tax return, right? So we got tax and book, right? So in that case, it's going to be, a difference there for it. So you can look at that. All right, the last thing, because we're butting up on time here, I don't like making these too long, is the idea with capital gains and losses for corporations, okay? How they account for this on their books is different than how they do it for tax, right? So first off, on books, right, if you have a capital loss, it's just going to be a deduction, right? You get the deduction. The idea on tax is you may be trapped, right? You may have deductions on there that you can't utilize. By way of example, right? Say that we have a C Corp, right? And I don't know, let's just say they sell phones, right? So they're selling iPhones, right? So there's the iPhone, that's great. And it's the iPhone 50 with like 12 cameras. And it's the limited U2 red edition, right? It's, we got the fancy one here. And let's just say they have $1 million of income from this. That's great, right? There we go. And then, oh, by the way, right? They have some GameStop stock, right? That they lost $5,000 on, right? It was a loser. They lost $5,000. The idea here is, first off, you cannot take this $5,000 and offset, the income. It's different income. They don't let you do that here. You're gonna have to keep it in its buckets. The best you get, right? So the first thing is you can't offset ordinary income of the business, the operating income, with the capital losses, right? So that's kind of rule 1. Rule 2 is, right, say that we also bought some other stock, right? And maybe this time we bought some WWF stock, right? So when I was growing up, it was WWF, now it's WWE, whatever, right? Let's say we made $13,000 on this. Okay, in this case, right, because it's kind of in the same bucket, the same type of income, yes, we can net them, right? And what we'll do here is, right, we will report $8,000 of income. And one thing on it, right, with corporations, you have to be aware of, all income is taxed at 21%. Stated alternatively, there is no preferential rate for corporations. Finally here, right, if we change the facts one more time, let's say that wasn't 13,000, let's say it was 2,000, right? So, hey, we're overall at a loss, right? $3,000. We know you can't offset that with it, but what do you do with it, right? Well, we said one on books is you get the deduction for it. On your tax return, you kind of don't. In other words, they make you kick the can. They say, hey, you overall were at a $3,000 loss. You can't offset the ordinary income with it. What you need to go is go back 3 years, right? Start here, 1, 2, 3 back. Did I have any income, right? Was there any WWF income or whatever other stock, right, to utilize this loss? Nope. Well, then I go here. Was there any other capital gain income here to utilize it? Nope. Nope. All right. So you go back 3. Then if you don't utilize it, then you carry it forward 5. Okay. So that's about halfway through the PowerPoint. I'm going to stop there.